Welcome back to the deep dive. Today, we're doing something a little different. We're not just looking at big ideas or, political manifestos. Our mission is much more concrete. We're exploring a highly structured proposal, really a blueprint, designed to build a real, viable investment alternative to the housing market. I mean, for too long, the housing debate has been all about slogans: build more, tax the unearned wealth, nationalize the land. But those rarely get past the bumper sticker stage. We have some source documents here that sketch out the full operating architecture for a system that could, actually exist. We're going to deep dive into how you could build homes and offer steady returns without relying on home prices going up forever.
And that's the real challenge here. And it's why this proposal is so interesting. It has to be a genuine balancing act. It has these three concurrent goals, and if it fails on even one, the whole thing just collapses.
Okay, so what are they?
First, it has to provide long-term investors, and think pension funds here, not quick traders, with a stable, reliable, what the sources call a boring alternative to owning property.
Boring, which is usually the opposite of what investors want. But in this context, I can definitely see the appeal.
Precisely. The second goal is maybe the most difficult one. It needs to unlock underused land and ensure homes are actually built, but without resorting to forced sales or government confiscation, the really politically toxic stuff.
Right. And the third?
It has to build housing in areas where people actually want and need to live.
Yeah.
So it has to respond to high demand, not just add cheap supply way out in the middle of nowhere.
So we're talking about resecting the existing structures, private ownership, market mechanisms, public need not, just sweeping them all away. So if we're respecting private ownership, this isn't about nationalizing property. That's usually the first critique you hear.
Absolutely right. And that initial framing is so crucial. The proposal is described not as nationalization, but as a semi-public, rules-based, long-term housing investment scheme. Think of it more like creating a parallel, stable infrastructure for housing investment that fills this huge gap that the current market just ignores.
Okay, let's unpack the money side of it. If you want capital to flow into this, you have to talk about the mechanics. What's the fundamental job of the scheme?
Its job is really to redirect capital. Right now, everyday savers, huge pension funds, they all default to property because it feels stable, it feels tangible. This scheme raises capital from that exact same pool. It uses that money to build and rent homes. Then it returns a steady, low-risk, inflation-linked income stream to the investors. And this is key. It recycles that income into more housing.
But if the focus is entirely on boring returns, I have to ask, how does it compete? I mean, with the massive returns we've seen in property over the last decade, why would a fund manager choose boring stability over, the chance to double their asset value?
Because for funds with, say, a 30 or 40-year horizon, that stability and predictability are massive assets in themselves. The sources are really clear. You're buying housing bonds, not speculative assets. The difference is critical.
A housing bond, not a house or a flat.
Right. When you buy a house or a real estate investment trust, a REIT, you're essentially betting on scarcity to drive up the asset's value. But when you buy these bonds, you're investing in the stability of rental income, the physical homes, and steady demand. It's a complete shift in risk appetite.
So the bonds are backed by flow, the steady stream of rent, not just the hope that the asset price will go up. What's the comparison for these bonds? What are they like?
They're explicitly compared to infrastructure investment.
Okay.
Think about roads, railways, water pipelines, power grids. These are long-term essential services that generate steady, predictable revenue over decades, often linked to inflation. Property speculation is like a lottery ticket. Infrastructure is like a utility bill. And the transactional outcome is summed up perfectly. You invest, you get a return, someone gets a home.
That really simplifies the whole thing, doesn't it? It shifts it from betting on scarcity to investing in a stable utility. Now, what about existing small landlords? That's a massive political group. If I own one or two rental properties for my retirement, am I just forced out?
Not at all. And this is where the scheme gets really politically smart. It provides a clean exit. Existing landlords with suitable properties could be offered the option to swap them directly for these housing bonds.
But why would they do that?
Because being a small landlord is, honestly, a tedious side business for a lot of people. You're dealing with maintenance, tenant calls, regulations, vacancies. Swapping the property for a bond means you keep a secure, long-term, inflation-linked income stream, but you offload all the hassle. It's an income for hassle trade. No fire sale, no forced exit.
That makes perfect sense for someone who just wanted the income but never really wanted to be a property manager.
Exactly.
Okay, we've covered the money, but the really sticky part is always the land. If this scheme needs to build in high demand areas, where does the land come from without confiscation?
This is the surgical core of the whole proposal. It avoids confiscation entirely, it targets land that meets very specific criteria, and it focuses on land that's basically being held hostage right now.
What do you mean by that?
We're talking about land that is already in a high-demand area. It's already suitable for housing, and it's currently sitting unused, or, as the sources say, underused.
So, urban infill sites, stalled construction projects, or valuable plots that are being land banked? For anyone not familiar with that term, land banking is just holding land and doing nothing with it, just waiting for its value to rise from scarcity alone.
That's the perfect definition. And land banking relies on doing nothing being the most profitable choice. Once a piece of land falls into that category, underused, high demand, the dynamic changes completely. A critical element gets introduced, time. A clear, defined time window starts, say 5 to 10 years. It's not an overnight threat, but it is a ticking clock.
And what choices does the landowner have while that clock is running?
They still have control. Choice 1, build the homes themselves. That's the ideal outcome. Choice 2, sell the land to a developer who will build within that time frame. Or choice 3, do nothing for now.
Okay, here's where it gets interesting. If the owner sells the land to a new developer, what happens to the clock?
This is the linchpin detail, the thing that changes the entire risk calculation for speculators. The clock would not restart.
It wouldn't.
No.
Mm.
If a developer buys land with 3 years left on its 10-year development window, they get 3 years to finish the job. Selling it doesn't buy you more time.
Let's just run through that. So right now, a speculator can buy land, sit on it for years, sell it to someone else, and the whole process just resets.
Often, yes. But under this scheme, that's impossible. If I've got a plot with a 10-year build mandate and I sit on it for 9 years, I can't sell it to you, and you suddenly get a fresh 10 years. You get 1 year. This immediately stops people from gaming the system by just trading land back and forth to delay things forever.
That's powerful. It completely flips the risk-reward ratio. So what if the clock runs down, the owner still hasn't built? Does the state just seize the land?
No. The system just steps in to make sure the homes get built. That's the public need, right? So the state would intervene to complete a stalled project or build from scratch. The point isn't to take the land, it's to guarantee the housing gets delivered.
Okay, fast forward. The scheme has now built the homes. What's the structure then? Who owns what?
It's all legally defined and very transparent. The original landowner keeps ownership of the physical land, and they receive a government-set ground rent for its use. But the buildings themselves, the physical structures, are owned by the housing scheme, and those homes are then rented out long-term, backed by the housing bonds we talked about.
And this government-set ground rent, is that just some low fixed price?
It's designed to be predictable and fair. It would probably be linked to inflation or some other national index. It guarantees the landowner a steady, low-risk, passive income. They don't have to manage anything. They don't have the construction risk, but they do lose that potential for massive speculative upside.
And what happens at the very end of the period? Let's say it's a 99-year lease.
There's a fork in the road, as the sources call it. The landowner gets 2 choices. They can buy the buildings back from the scheme at market value.
So they acquire the vertical asset.
Exactly. Or they can surrender the land itself to the scheme. The crucial thing is the land never just sits there doing nothing forever. It forces action.
So you can see the behavioral change this drives. Doing nothing stops being the easy win. It results in a stable income, sure, but you lose control and the big speculative prize.
And for developers who actually want to build, the risk profile shifts. Building stops feeling like this huge gamble on prices always going up. You get steady returns without needing scarcity to prop up asset prices.
But whenever you introduce these kinds of clocks and boundaries, there's always the risk that speculators just move their focus. They'll buy land right on the edge of the scheme's boundary, betting it'll move in a few years. How do you stop that?
The safeguards are built into the activation criteria. First, the scheme only applies where housing demand already exists. It's not a tool for opening up, greenfield sites. Activation depends on measurable things.
Yeah.
Existing high demand, nearby residential use, access to infrastructure.
So it keeps it focused only on those areas of urban urgency where the market is clearly failing.
Correct. But what about your point on speculation? What if infrastructure does expand and a new area suddenly meets the criteria? Well, if previously unsuitable land enters the scheme, the clock starts then. And again, the most critical safeguard is that selling the land does not reset the clock. You can't just buy up land hoping it becomes high demand in 5 years and then trade it around to extend your hold. It won't work.
This whole mechanism just seems designed to make it economically unfeasible to hold valuable land empty. Which brings us to the big question I'm sure is on a lot of people's minds. Why isn't this just socialism by another name? The state is setting rent, dictating timelines, owning buildings.
The source material really tackles this directly by detailing what isn't being nationalized.
Yeah.
I mean, land stays privately owned, participation for existing landlords is totally optional, and prices for the land and homes are still rooted in market dynamics. The state isn't replacing the market.
But if the state is stepping in to guarantee building and manage the supply, what is its role then?
Its role is an infrastructure provider, a utility provider. We all just accept that the state or regulated companies provide roads, water, power, the foundational utilities you need for a functioning economy. This proposal just argues that stable, affordable, well-located housing should be treated as essential economic infrastructure too. The state is providing the mechanism to deliver that utility.
That reframes the whole argument. The proposal defines itself not as social engineering trying to tell people how to live, but as risk engineering.
That's the perfect term for it. It's about shifting incentives. It recognizes that the current risk calculation, where the safest bet is to hold land and do nothing, is fundamentally broken for society. So by making doing nothing non-profitable for speculators, they re-engineer the risk to favor construction and stability.
Risk engineering, I like that. It's about shifting incentives, not eliminating private enterprise. So zooming out, what's the overall impact of a scheme like this on the housing market stalemate we're in now?
Well, it does three vital things. First, it creates an essential off-ramp for all that capital currently trapped in speculative housing. Second, because the investment is backed by rental income, it lets homes be built without needing prices to keep rising forever. It breaks that cycle. And third, it adds significant, guaranteed supply in the right places without pushing private builders out of business, because they're focused on totally different kinds of returns.
It gives savings somewhere else to go besides just the ownership market, which in turn has to reduce the pressure on the cost of just owning a home.
Precisely. It's a mechanism for stability and output, a framework to unlock land, build homes, and attract long-term capital without having to blow up the entire system.
A structure designed for practical, achievable change. It respects the existing rules of the game, but changes the incentives within it. Before we wrap, I want to leave you, our listener, with one last thought to mull over. We talked about that role that selling land in a high-demand area does not reset the development clock. Just imagine a speculator who bought a valuable plot expecting to sit on it for 20 years. Now there's a 5-year clock ticking, and they can't just pass that ticking bomb to another buyer without a massive discount. How dramatically does that single detail change the immediate financial calculation for any high-demand area landowner right now? It really flips land banking from a guaranteed win to an active and risky decision. That's it for this deep dive. We've enjoyed unpacking this with you, and we'll see you next time.